Hello, everyone. In this short video, we would like to outline the main ideas and structure of our paper, Responsible Investment and Stock Market Shocks, Short-Term Insurance Without Persistence. Maybe, Jana, you would like to start out and introduce the main ideas of our paper first.
ESG investment strategies have become very popular, both for retail and institutional investors. But does ESG-related investment also provide further advantages beyond a good conscience? Does it perform better? Theory is ambiguous and empirical studies find positive and negative effects. With our paper, we focus on whether ESG preserves rather than generates value, and therefore becomes a useful addition to an investor's portfolio from a risk management perspective. To evaluate the potential risk mitigating effect of ESG, we analyze whether and to what extent share prices of firms with higher ESG ratings remained more stable during the COVID-19 shock and beyond. Our findings: it depends. Let's find out when ESG is an insurance effect and when it isn't. But first, let's start with the theory and define our research hypothesis. Uwe, can you maybe tell us a little bit more about it?
Thanks, Jana. Our analysis is based on the theoretical notion of ESG being a risk mitigation instrument based on an insurance-related theoretical framework and the notion of building trust vis-à-vis investors via ESG. With regard to the insurance-based theoretical reasoning, we follow the arguments put forward by strategy scholars as well as the ones carved out in related empirical analysis. This literature underscores the importance of risk considerations when investing in ESG assets, as well as the long-term orientations of such investors. To explore the particular effects of the COVID-19 shock to stock prices in detail, we consider the two driving forces behind stock valuations: cash flows and required returns. First, we conjecture that due to trust and long-term relationship reasons, stakeholders tend to stick more to high ESG firms in the course of a significant crisis, leading to less anticipated downward pressure on their cash flows. Second, due to longer-term orientation of ESG investors, they revise their required return less upward in the case of a crisis compared to other firms. Both effects on cash flows and on required returns leads us to our first hypothesis, namely that less pronounced downward pressure on ESG stocks leads them to outperform after a systematic shock. However, our argumentation also implies that when the systematic shock peters out, the outperformance of ESG firms should vanish, our second hypothesis. Let us now outline how we did test these two hypotheses. Steffen, can you please take over and outline our main empirical approach?
Yes, thanks, Uwe. Our sample comprises all publicly listed non-finance firms headquartered in the European Union. After excluding some companies, such as companies with missing data or microcaps, we are left with 1,022 firms. We use Thomson Reuters as our source for the ESG scores. We employ two methodologies: an event study exploring the abnormal return during the crisis and afterwards, and a difference in difference analysis. We use the outbreak of the COVID-19 pandemic as the event date for our event study. Following the literature, we define a crisis period of 17 days. The end day is defined by the coordinated central bank action. That allows us to calculate the role of the ESG scores in the crisis period. We find that companies with a higher ESG score have significantly higher cumulative abnormal return in the crisis period. See our table 5 here in the corner. To give those estimates some perspective, a 1 standard deviation increase of the ESG score is associated with a 1.8 percentage point increase on average in the cumulative abnormal returns during this crisis period. We then also calculate the abnormal returns for different lengths into the pandemic. This allows us to analyze the dynamics over time. We start with 1 day and expand our observation window step by step on a daily trading day basis. We move the window forward for a maximum of 60 days. For each window, we run a regression estimating the effect of the ESG score on the respective cumulative abnormal returns. That allows us to plot the coefficients over time. Figure 2 shows the development of the estimates and its confidence interval over time into the pandemic. The dashed line shows the 17th day, the end of the crisis period that we used in our first step of the analysis. We observe that the coefficients are only significant around this time and that the coefficient decreases quickly after the invention of the central banks. We find, consistent with previous studies, that there's an outperformance during the crisis. However, we now also show that this outperformance is not persistent, but peters out over time. Our preliminary conclusion at this point is that we observe an insurance effect, but no long-term outperformance. In the next step, we switch from the classical event study to a difference in differences analysis. We use the daily abnormal returns as a dependent variable and again the ESG score as the main variable of interest. We use 10 days before the crisis as the pre-period. And the beauty of this difference on difference approach is that it allows us to control for time-varying country-specific effects. These are particularly important because the health conditions, containment efforts, but also support schemes differed strongly across countries. Consistent with the event study, we find an outperformance of high ESG stocks during the crisis. We then also analyzed the persistence by adding an additional 17 days to our analysis, the post-period. We again observed that the ESG score plays a role during the crisis, but not afterwards anymore. We then run a number of additional robustness checks, such as using a median split of the ESG score, using raw returns, and leaving out some countries, and find consistent results. So after those results, Jana, can you tell us a little bit more what are the implications and main takeaways from our study?
Yes, sure, Steffen. First, we provide evidence of the risk mitigation insurance-like effects of socially responsible investment. Second, we show that this effect is economically rather small, and in our view, even more importantly, fades away completely in the recovery of the market. We think that there are three main implications of our paper. The first implication relates to shareholders. ESG orientation is associated with an insurance effect in a severe crisis, implying that there is a benefit to ESG investment. Second, our findings have implications for managerial decision-making. ESG orientation is a valuable ingredient in the risk management toolbox, protecting against pronounced downside risks. It is, however, not a general equity vaccine, but rather one with a limited lifetime. Last but not least, our findings imply that in this context, concentration on the environmental and social dimensions pays off, and that the governance perspective can be neglected. Thank you for your attention. We very much hope that we have inspired you and that you desire to dig deeper into our analysis.